Well, good morning, traders and investors. Today is Friday. It is January 22nd. We're almost at the last trading week of January. Markets are soft today. The Dow's down about 260 points. On the far month, a near month, 237 points. The Nasdaq is down about 80 points. Why is this happening? Well, it's because of global economy. China is getting infected with COVID again. Folks, it was only a matter of time. Let's get into it right now, and then I'll give you a good update of where we stand with earnings. About 10% of earnings are out right now, so I want to kind of give you a broad stroke view of where we stand, how we're going, and how it'll impact your trading. So, global stocks, U.S. futures, they retreated Friday after a resurgence of COVID-19 infections in countries including China, which is the second biggest economy in the world. Optimism about rollout of COVID vaccines was dented by a spike in infections in China. There you have it, where the disease has been under control thus far. In Europe, sentiment was also dented by a survey of purchase managers that showed economy activity shrank in January. Bad sign for global economy. Markets have been encouraged by the inauguration of Biden, who proposed $1.9 trillion, including $1,600 cash. China, where the pandemic began in 2019, as everyone here knows, has reimposed travel controls after outbreak in Beijing. And this is a major city here, major financial city, and other cities. The government is building isolation hospitals with thousands of beds in Hebei province, which abuts the capital. Very important. They announced 103 infections on the 11th day with more than 100 confirmed cases. That's bad. Chinese government has called on the public to avoid gatherings and all the other good jazz that we've been familiar with. Folks, does this sound familiar to you? Do you remember about 9 months ago, I said we're going to see exactly the same thing happening first quarter of 2021? Well, we're here. Deaths are rising in Indonesia while case numbers increase in Malaysia. Folks, all I'm going to say is, here we go again. Yeah, it would be hard to assume that we would get out of COVID with this just one little, one correction. It just didn't seem realistic. And folks, I'm going to tell you again, healthy people in the United States of America still do not have vaccine. I know you've heard otherwise. Israel has 70% of people inoculated, whereas America, we've got I don't even want to go there. It's pathetic. That's a problem because last week unemployment rates was 900,000 new claims. We're going back to where we were in February, March, April of 2020. And as you could see, this is not a good start to 2021. Now, in terms of global economy and news, earnings is what's driving this market right now. So let's look at the S&P 500 as a whole. And as you could see here, and I've been talking about this since day one, look at the divergence. Look at the RSI right now. We are at the highest high we've ever been. Look at it here. It's at 86. And look at it here. It's at 68. The fact that RSI can't go up is very, very meaningful. And the longer this thing continues, the longer this divergence continues, here, see, upside, downside. The longer it continues, the worse the correction will be. I would not be surprised if before the end of this quarter, the S&P broke the 50-day moving average and made its way into what I call the twilight zone, which is the area between the 50-day moving average and the 200-day moving average before going back up. I don't think there's anything fundamentally wrong with this market long term, but I think we are overbought technically. Sentiment, everything is pointing to a mild correction, much like what we saw here around September of 2020 and what we saw October of 2020. It's been quite a while, and we need this correction in order to shake things up and move higher. But looking at the overall market, let's look at the overall. Overall, the fourth quarter is starting well with very high proportion of companies beating estimates. Now, remember, all of these companies that are beating estimates, they have broken down and lowered their expectations on estimates already like 7 times between February of last year and now. So the fact that they're beating estimates is not such a great deal, but they are beating estimates, which things are slightly better than expected. But the fact that they're all beating estimates isn't such a big deal because all these estimates were beaten down beaten down and beaten down and beaten down. This is helping sustain the positive earning revision trend that has been in place since June of 2020, the last quarter. For the 43 S&P 500 companies that have reported, actually, this is from yesterday, early yesterday, so there's about 50, about 10% has reported. Total earnings are up about 7.5%, 8% from the same period year ago on about 3% higher revenue. 93% of the companies out of the 50 companies, so take that with a grain of salt, have beaten the earnings per share. 75% have beaten the revenue estimates. Now, banking industry, banking. Citibank, JP Morgan, Chase, Bank of America, let's talk about it. Usually, earnings start off with big banks. That's just how it always has been. Banking industry, which dominates the early reporting docket, has reported markedly better earning results compared to the first quarter of the year. Again, they were all here, with all the major players reversing their early loan loss reserve buildups. That's a positive sign in the right direction. But again, till the economy, till GDP begins to really pick up, I don't think we're going to see a lot of relief, regardless of how these banks do. The biggest impact was JP Morgan. JP Morgan was up 42.4% for the same period last year, followed by Citigroup, which was up 4.2%. Bank of America and Wells Fargo, not good. They released loan loss reserves as well, but their four-quarter earnings are still below the year earlier levels. But the fact that they're releasing these loan loss reserves is a positive sign in the right direction. But as you can see here, banks have a lot to go. This is a chart of Citibank long-term. Notice it still has not gone above the previous February highs. And if you look at Chase, it has just now gone above the previous February highs. My big test is only to buy stocks that have gone past February, March 2020 highs. If they have not gone above that level, then that's a short for me. So for the financial sector as a whole, we're looking at 38% capitalization so far that has reported, and things are looking better. Total earnings for this sector, for this 38% of the sector that's reported, remember, you got to take all of this with a grain of salt because only 10% of the index has reported, but 38% of the financial sector has reported. Total earnings are up 15% on flat revenue, with 90% beating earnings per share, 62% beating estimates, and again, take those numbers with a big grain of salt. Now, looking at the total earnings for the S&P as a whole, we'll write this down because if the numbers are better than this, that means the market's doing better. If they're worse than this, the market's doing worse because these expectations are boiled into the market right now. Looking at it as a whole, we're expecting revenue to be down 6.4% on flat revenue, which follows a 7% decline last quarter and 0.7% lower revenue. So not big change. 6% down now, 7% last time. Things can get better. That's the expectations. For the financial sector, we're looking at the number to be up about 10% from a year ago, which would follow a decline of 11%. So financial sector is looking quite a bit better. But the overall market's looking about the same. Financial's looking to be positive 10. It was negative 11 last time. Now, let's talk about technology sector as a whole, which is actually breaking out right now. They're expected to be flat, about the same, on about 10% higher revenue, but flat in terms of earnings, which follow a earnings growth of 13% last quarter. So technology earnings actually were expected better last quarter than this quarter, which is kind of interesting. Here is how you break down the technology sector, and you should pay very close attention because this is much in line with what I've been saying. Here is how we separate the two. Computer hardware, 7% decline. Semiconductor, 3% decline. Telecommunication services, 10% positive. Software and service industries, 6% positive. And looking at it from a calendar year, for the entire calendar year, not just a quarter, S&P 500 earnings are expected to decline about 16% on 3% lower revenue in 2020 and increase of So in 2020 we were expecting a 16% lower revenue. In 2021 we've got an increase. We're expecting 23% positive revenue. So both estimates and expectations have gone up. So 16.3% negative and 3.6% lower revenue 2020. This year we're looking at 23% positive revenue on 7.6% higher revenue. So keep those numbers in mind. Last year 16% negative, this year 23% positive. And that's what's driving the market right now. Now, I like the fact that tech is breaking out. And also, let me just show you something interesting. I wasn't planning on going into this, but you know me, I like to go deep. So if you look at the 10 major sectors right now, and I wanted to give you a visual chart. Look at financials, they're breaking down. But again, if you look at a 2-year number, you will see that they're just now above this level, this February level, which is important. If you look at energy, you will see way below that level. If you look at industrial stocks, always look to see how they're doing. Notice breaking above that February level. So right now, the sectors that I like are industrial. I like this flat basing. It can break up while everything else is sort of breaking down right now. I like basic materials, although it looks a little weaker right now. I like healthcare quite a lot, and I like technology. So right now, based on everything I'm seeing, I like consumer discretionary, I like technology, I like healthcare, and I like industrial. I'm so-so on industrial and basic material. I'm sideways on it right now. And I'm bearish on financials, but I do like the healthcare sector, I like the technology sector, and I like consumer discretionary sector right now. And yes, each of these sectors, as you'll see right here, has taken out the February, March high of last year. If you're looking at an asset, an index, an ETF, and it hasn't taken out the February, March 2020 high, forget about it. Shrug it off and just forget about it, because if it hasn't done that, that means it's a short. It's not a long. Now, I've given you a lot of information today, a lot of information, a lot of usable information, because these expectations is telling you what the market is aiming for and what it's targeting. And if it doesn't hit that level, things can go south very, very quick. Or alternately, things can go north very quickly. So folks, pay attention, because I've got something even better for you. The media is buzzing about President Joe Biden's inauguration and what Democratic-controlled government could mean for the U.S. economy and Wall Street. I mean, look at the healthcare sector. It's already turning around and going higher again. Anytime big news like this breaks, it can have the potential to impact stocks and cause volatility, lots of market volatility. And this new change of the guard couldn't come at a more tenuous time. I mean, really, we need it right now. I've been warning my readers for weeks what the broader indexes are doing. And folks, they're looking overstretched. They are. Momentum levels, divergence, put to call ratio, everything is pointing to overstretched market, meaning they could snap back at any moment, especially some of these sectors. Now, I'm not saying this could be the catalyst that I'm not saying this is going to be the catalyst that shakes up the market, but it doesn't hurt to start preparing now for a changing climate. Folks, I'm telling you, 2021 is not going to be like 2020 or 2019. This is going to be a very different year, a very dynamic year. To get started, I've teamed up with my expert trader and partner, Tom Busby, to bring you timely training seminar. In it, we'll show you how to spot stocks that climb, regardless of headline news or market volatility. Again, folks, markets are stretched out. There's going to be volatility. I want you guys to take advantage of it. Tom Busby's been doing this for close to 40 years, all right? And I've been doing this for 27 years. You've got to check this out. This is really, really timely, especially with the volatility, especially with the earnings, especially what we're seeing with the resurgence of COVID right now. You do not want to miss this. Get started, follow the link below, and see what we've prepared for you. Do it now. You're going to get so much value out of this. You've got to bring a piece of paper and a pen so you can take notes. We're going to give you actionable, real statistical data that you can bank on. Do it now. Follow the link below. Tom Busby does not disappoint. And, well, either do I. You guys have a great weekend. Post some feedback for me here. I love hearing feedback. I want to see how your 2021 is doing so far. Have you guys made any money following my trades? Let me know. Have you lost money? Let me know. I need feedback. I thrive on feedback. Good, bad, doesn't matter. Feedback. Have a great weekend and stay safe. Bye, everyone.